Okay, I wanted to give a minute. Oh, that's cute. I saw your dog. Okay, so your debits and credits, you want to make sure you have both sides. You want to make sure that you understand the type of account that you have, whether it's an asset, liability, owner's equity. You want to make sure you understand that. If you look at some of the PowerPoints, they have really good kind of like diagrams that break out the sales and expenses, and kind of memorize some of that. So you know, okay, if I have something that's an expense, I know I need to debit that. And then you're real comfortable with that. So you know, anytime that something has to be an expense, I'm going to debit. And then that helps you have part of the problem. Once you have part of the problem, it's easier to solve, like where does the credit go? Or like I was saying with the accounts payable, if you have an accounts payable, you know that's a liability that will carry a credit balance, then you know that that's that part of the entry. What's going to be my other side? Well, I got to figure out what kind of expense is it? And then I'm selecting an account to put it in, and that will be my debit side. I hope that helps a little bit with the credits and debits.
Yes, definitely.
Okay.
It's just kind of getting used to it, I guess. This is, I guess, the first accounting class. It just takes time to get used to it.
It does. And sometimes it feels backwards. And so, you know, but when you start working with it a little more, it helps. Sometimes people get it. Sometimes people don't get it. Sometimes accounting is really difficult for some people. You could even be good at math and still not really fully understand the concepts of accounting. So, you know, it's just a lot of practice and getting used to how to do it. Practice your homework problems, you know, a couple of times, and just get used to those problems, and memorize what kind of account is going to have what's their normal balance. That will definitely help when you're working through problems.
Cool. Thank you.
So do y'all have anything specific on the exam that you remember that you would want me to go over?
I don't remember anything.
So on the exam, let me just kind of go over some of the things that you had on the exam. So you had to know how to get to your equity, and that's real important. So you have to know that you're going to have beginning equity, and I think I might have put this formula in your study guide. Know that whenever you have your equity that's on the owner's equity section, whatever that is at the end of the year that comes forward into the new year, and it rolls in your income or your loss from the previous year. So you're going to have a beginning balance. Some problems we do are basic and you might not have a beginning balance, but you would start with the beginning balance of the owner's equity. And then you want to add in your income. So anytime you see when you do your income statement, you have income, that gets added to the equity. If you have a loss, it's going to come out, it's going to deduct. But if you have income, it's going to get added to your beginning equity. And then if you pay out dividends, when you pay out any dividends, think about that as money that's going out. It's no longer part of the income that you have for that year. You're taking a portion of what your income was. Let's say your income was $2,000 and you decided to pay out 1,000 of that. So now you only have 1,000 left in equity. So you're going to have to deduct. So your income would be 2,000 you're adding, and then you subtract out your dividends. That gives you your ending equity. So that was one of the formulas I wanted you to know how to do, was to be able to come up with that equity. So you do have to do your income statement and figure out your net income first, because you'll use that when you're figuring out equity if it's not given to you. We also had the basic formula: assets equals liability plus owner's equity, and just knowing how to plug those numbers in. And so if I have my asset number over here, and then I have equity number over here, I have to know how to solve that to get to my liability. So you just have to remember that the liability plus the owner's equity is going to give you your assets. Okay. So the other thing was revenue, expense, income, gross profit. We went over some of that in those first 4 chapters. So I'm sorry, my daughter just walked in. Okay, so you want to take your revenue is your income that's coming in for that period. It could be your period could be a month, your period could be 3 months. Every company is different. Some people prepare financial statements every month. And so you'll do your income statement, you'll do your balance sheet, cash flow, you'll do them every month. And then other companies redo quarterly, so we don't look at it every month. But I work for a real estate company, and so we don't have, you know, a lot of jobs and things like that that are going on. A lot of our stuff is, you know, the same types of expenses. Sometimes we have expenses at the buildings, but a lot of them are recurring, so we only do ours quarterly. Other companies that I've worked for, like I worked for audiovisual company. So you're doing jobs all the time. They like to look at that and then do analysis on the jobs, and they like to see their financials every month. So you may be looking at this period of 30 days. You could be looking at a period of 90 days. You could be looking at a period of a year, depending. So you're going to take your revenue for that period, and you're going to deduct all of your expenses for that period. That gives you your net income. Okay. Then I think it was chapter 4 that we added in merchandise. If you sell merchandise, then you have your costs, and you have a gross profit margin, or you got gross profit. So you would take all of the revenue and you would deduct out your cost associated with that merchandise. So anytime you have like a car dealership or audiovisual entity or somebody selling parts, a lot of times that's going to be their structures. You're going to see the sales less those costs, which could be labor, it could be materials, and that's going to get you to your gross profit. The gross profit is before your regular operating expenses. So then you'll have expenses come in and you'll deduct those from the gross profit to give you your net income. Does that make sense? It's still revenue minus your expenses, but you're breaking them up in 2 different places. So you might have less your cost, and then you have your gross profit, and then you'll have deduction of your operating expenses, and then you have your net income. Does that make sense? So we had a little of that. The other thing I feel is important is those T accounts, which we had on the exam. And a lot of people had some problems with those T accounts. So the T accounts, keep in mind, those are going to require you to input every transaction that happens is going to have those 2 entries. So you'll have, it hit 2 different accounts. So the T account is just representing, when you set up the T, that's just representative of one account. So you'll have multiple T's, with each one having an account number associated with that one. So if I start up a business and I have cash, then my first on the example I gave on the study guide is you want to make sure that you take that 50,000 for your cash, you set it up in the cash as a debit, because I know cash is an asset. What's my asset? Have a normal balance. A debit is my normal balance. So I'm going to set up my cash, and then I'm going to set up my common stock, which is in my owner's equity section. It carries a credit. So then that's my in and out credits and debits balance. So the T accounts just basically walk through different transactions, and each one of those transactions, you'll have an input. In the end, you may have several entries in cash, you may have several entries in accounts receivable, accounts payable, common stock, whatever accounts you had, you may have multiple in there. And you would just add your debits and add your credits. And whichever one is higher, that's where your balance is. So in cash, hopefully you have a debit balance in the end. Because if not, now you're negative. You don't want negative cash, right? Nobody wants negative cash. So in the end, hopefully in your cash account, you have more money added up in that debit column than in that credit column. So in the end, you take the difference between the 2. And let's say I had 10,000 on my debit side and I had 5,000 on my credit side. Then I know my balance in that account, I take the difference, it's going to be $5,000 on the debit side. So when I move that transaction from the T account into the trial balance, I know it's going in as a debit. Now the T accounts, you probably will never see them. You probably will never really see what's happening when you do transactions in an accounting software, because the computer does it for you. This is breaking it down where you're learning what is that software doing with these numbers? Where is it going? How do I understand this? So when you do a journal entry, you'll have to know what's a debit, what's a credit, but you won't see a T account. The T account is just helping you realize that there's going to be multiple transactions throughout a period of time. They're going to be debits and credits usually. And at the end, you have to know how to get to the net. And that net amount will determine if it's a credit or if it's a debit. And then that's what gets pulled over to the trial balance. Does that make sense with the T accounts? Do y'all have any questions?
No questions.
Okay. Another thing that we had was preparing an income statement and knowing how to do that balance sheet. So your income statement you would do first, and you just take all of the income less the expenses, you come up with your net income. Then you would do your balance sheet. Your balance sheet, you're going to be looking for all of your assets to go together and add them up. Now remember the equation, assets equals liabilities plus owner's equity. So when you set it up, when you set up the balance sheet, you can put cash on one side and owner's equity on the other side. Sometimes they put them on top like this. I like to show them side by side so you can see at the end that you have the same balance. So all of your assets are going to go in one column and you'll get a total. And then all of the asset, the owner's equity and liabilities are going to go in another column, and those will add up, and they should be the same in the end. So the balance sheet's going to have all your assets, which is like your cash, your accounts receivable, your notes receivable, supplies. We did use supplies as an asset. And so you would add those up and come up with a total asset. Your liabilities are going to be your accounts payable, anything that you're liable to pay in the future. You're liable to pay out to these vendors for merchandise that you purchased. You're liable to pay for your utilities that you're using in your building. You're liable to pay those payroll fees, the salaries. Another one is unearned revenue. So y'all should have had some problems with the unearned revenue. Unearned revenue means that somebody's paid you for something and you haven't done it yet, but you're going to do it in the future. So I got paid to do a job. Say I'm going to do Daniel's taxes and he paid me in advance. So now I have a liability to owe him. I have a liability to pay him those services in the future. So you can think about it that way. It's not going to be cash that I'm required to give him, but it's going to be a service that I'm required to give him. So that's what the unearned revenue is. And I think that a lot of people get confused with that being a liability. So you'll have all your liabilities, and then you'll have your equity. And for this class in your equity, you're going to have common stock. You're going to have retained earnings. And then you'll have your ending where you add the two together and they should balance. Your retained earnings are also an accumulation of your income and like your net income and your net loss. So every year, whatever you have in income, that net income number is going to roll into your retained earnings. Does that make sense?
Mm-hmm. I was wondering what that was for, retained earnings.
Right. So what happens is at the end of a period, so let's say our period is 12 months calendar year. In December, for that year, we want to know, what did we make? Did we do good? Did we not do good? So you're going to be looking at all your sales, less all of your expenses, and you're going to have your income. And when we roll into the new year, we close out all of those accounts. All your income and expense accounts get closed out. So that way the next year, you will have a brand new start. Your assets and your liabilities will stay on the books. So if I purchase equipment for that year that I'm using to produce a product, I don't want to get rid of that off my books, right? I have the assets still in-house. If I have inventory on the shelf, I want to make sure that whatever that ending inventory was, it comes forward into the next period for the beginning balance because I have it on my shelf to sell. So those types of accounts you want to keep. Liabilities you want to keep because I have some things at the year end, I haven't paid everything out yet. So I still have my utility bill and I still have some, inventory of shoes that I purchased and I haven't paid for those yet. But when I roll into a new year, I'm not going to get rid of that because they're not going to just forgive your debt, right? No, they're going to want you to pay in the future. So you have to have your detailed reports that show you what is payable in the future. And so that comes forward. You don't get rid of those accounts. But the sales and the expenses, you do. You wipe those out. You close them out by clearing out those accounts to zero. You use an income summary type account to close out. And then everything rolls into the retained earnings, which is just the net, which is net income or net loss. That's going to roll into your retained earnings. So now that that's in retained earnings, over time, it's just going to keep building. And hopefully you're making money. So every year it's going to build and get bigger and bigger. So, so then the new year you start over and now you're looking at a new period. So when I'm like, okay, well, how much money did I make this year? And I run my income statement, I'm only looking for that period of time that I want. It could be that month, could be that, the quarter, could be the whole year. But I don't want to bring in last year. I just want to see this year. So that's how the income statement is. Those income accounts and the expense accounts, they get closed out. So everything rolls into retained earnings. All right. We did some journal entries. We talked a little bit about expenses. We know expenses carry a debit balance, right? So we want to make sure we put our expenses as a debit. The offset, the credit, depends. Am I paying something right away? Well, then I'm crediting cash. Am I going to have a liability for the future? Then I know that I'm going to credit my liability account. So that's how you would do the journal entry. It's just kind of think about the process of what's happening. Cash is real easy. If cash is coming in, you have an asset, right? So it's going to be a debit balance. If I'm sending cash out, well, then my cash needs to be reduced and I got to do the opposite. So I credit. Let's see what else we had. Prepaid expense. We talked a little bit about that. An insurance policy is a great example because you're purchasing up front the whole thing. Now, if the only time you would consider that entire amount that you pay as an expense is if you're doing cash basis instead of accrual basis. The cash versus accrual was on the exam as well. So cash is only using cash. If I paid it out, it's an expense. If I collected cash, it's income. So it doesn't matter if I didn't do Daniel's taxes yet. If I got paid, I'm counting it as income. If I paid out that insurance policy and I know that it's for next year, I'm still going to expense it because I'm on a cash basis. The accrual basis is different. That's when we look to see, we try to match, when is that expense happening? Does it match when the sale happened? You want to try to match and kind of even those things out as you go. That's what the accrual method is. So when I purchase that big chunk of insurance, now it's prepaid, it's an asset, it sits as a debit. When I go through the year, I need to reduce that account down. So how am I going to reduce prepaid? I'm going to credit. What's my debit? What do you think the debit is? Do y'all know?
Prepaid insurance?
It wouldn't be prepaid. Prepaid, we're reducing that over a period of time. So that's going to be my credit.
Insurance expense.
Insurance expense, because now it's an expense for that period of time. So I'm just taking, let's say it's 12 months. I'm going to take that and I'm going to divide it by 12. And so over 12 months, I'm going to have that same amount hit every month. So that's my expense. The expense is that monthly amount. Every month I'm going to hit it. Or if I do it quarterly, sometimes we do it quarterly. We wouldn't do it monthly.
I'm sorry.
Go ahead.
Are you basically taking it out of prepaid expense for the period of time? So like if it was 3 months?
Yeah.
You are?
Yeah. So let me see if I can show you my screen. Hang on one second.
Trick is debit on the left side. So we use if we do the journal, we put it the debit first and then credit later.
Yeah,
so
you always want that format. Let me see if I can share my screen. This screen here. Okay, so tell me if you see my whiteboard. Okay, so here I have prepaid insurance. Let's say it's $12,000. So I know that I'm gonna do a 12-month policy and I want to expense this for the whole year. Well, I'll just divide it by 12 because I got 12 months in my period. If it was 24 months, I would divide it by 24. So I have $1,000 a month that I want to expense. When I set up my journal entry, the format is always to put your debit first and then your credit second on that next line. You can have multiple accounts that are debits. You put them all there and then do your credits underneath. So the debit, a lot of times the software that you use when you put a journal entry will not be formatted this way. So when you're entering a journal entry in the system, you're basically going to have a couple of different things. You may have select the account and then you have a debit column and you put the amount there. And then you go to the next line, you select the account and you go to the credit and you put that in there. It won't necessarily be indented, but for the classroom, the proper format of journal entries is the debit and then there's a little indentation for the credit. All right, so my debit when I'm doing insurance is insurance expense for how much? Well, I only made it through 1 month.
1,000.
So it's going to be 1,000. If I'm doing quarterly, I would do 3,000 because I'm doing 3 months. So my credit, I have over here my asset account, my prepaid insurance. Here's my T account, and it's $12,000. Okay. So now when I'm doing this entry, I want to reduce that. Every time I expense it, I want to pull away, pull away, pull away
Put it
until I
on the
eventually
credit.
get down to 0. So my credit is the prepaid insurance for $1,000. And then over here on my T account, I put $1,000. Now what's my net? 11,000. So when I go to my trial balance, that's my balance right there. I'm going to bring in 11,000 debit balance that's in that account. The next month I do the same thing and I keep going. So when I get to December, I now have a 0 balance in my prepaid, and through the year I have that whole $12,000 expensed. If it's January through December, a lot of times insurance policies are not January through December, just to let you know. Does that make sense? For prepaid? Okay, so that's called an adjusting entry. And the reason why is because I need to adjust my books for those types of transactions. You could have, like I said, revenue. It could be that you took some money. So the cash is going in as a debit. My credit is my liability. Well, now I need to provide services. So maybe I got paid in advance $12,000 and I'm sitting with a liability on the books now. Let me see, scoot this over. So let's do it the other way. So if I have somebody prepaid me and it's unearned revenue, means I didn't do it yet. I got paid $12,000 to do accounting consulting or something. So on my T account, I have this liability account and I call it whatever, consulting. And it's 12,000 sitting as a debit. I mean, a credit. Why is it a credit? Because it's a liability. I owe somebody something. I am liable to provide that service. So when you think about liabilities, think you're liable for something. You're liable to pay money out or you're liable for a service. So I have a 12,000 balance. So the first month I did some consulting work and it was for $1,000. So now I can recognize that I provided that service. I need to reduce that account. Well, how am I going to reduce it? I'm not going to credit it like I did the other one. I have to debit it. Right. And so over time, that's going to be reducing by debiting. So just because you're debiting doesn't mean it's increasing. It could be decreasing. So I'm going to decrease that account. So I know my credit side. So I'm going to put my credit side first because I know that that liability for consulting is going to be my credit side of $1,000. This is kind of, let me scoot it over a little bit. Oops, hang on. All right, so I'm crediting that liability account that's consulting for $1,000. Well, what's my debit?
Cash.
I'm sorry. Hang on. No, not cash. We're not doing cash. I already got the money. I just messed up.
Oh, so would that
Hang
be,
on.
or,
Hang on. I'm doing the opposite of what I was telling you to do. So if I have this liability that's a credit, I need to debit it, right? So we need to debit that liability account of the $1,000. What am I crediting?
Unearned
Right.
revenue.
Revenue. That's income. Anytime I have income coming in, it's credit. So this is my revenue for consulting, or my sales for consulting, or income for consulting, whatever you want to call the account. So now I have $1,000 over here, and at the end of that period, I have an $11,000 balance as a credit. So when I do my trial balance, I make sure that I pull this balance of 11,000 and put it in the credit column. So that's another adjusting entry. And so all we're doing is we have the, we have our books that we're looking at, the balances in all these accounts. And we have to determine what do we have on the books that we have to do an adjustment for. Sometimes we find errors and we have to do adjustments for those. Sometimes we have these prepaid expenses. Sometimes we have these liabilities that we have to do some sort of entry. A lot of times there's one that's real common in business is you'll have to do something called accruals. And so what you're doing is you're recognizing that maybe a service was provided to you, but you haven't gotten the bill yet. So maybe I hired somebody to come in and go change some LED lights at one of my buildings. And I know that the work happened, but I haven't gotten that invoice yet from that vendor. So I'm going to go ahead and set up my expense. Let's say it was $2,000. For $2,000, I'm going to hit my, my lighting expense or my supplies or whatever it is, my account. I'm gonna debit that account. And then I'm gonna set up a liability that I'm liable to pay this guy in the future. So it's not yet an accounts payable, but it's a liability. It's an other liability that I'm gonna owe in the future. So when I get the bill, then I can enter it in and wipe out that liability and set up my accounts payable and get them on the books and run it that way. We'll get into a little more of the revenue, the receivables and the liabilities. We'll get into that a little bit more later. So, okay, so far, are y'all good? Do you have any questions? Okay, so we talked about prepaid stuff. We talked about accrued, which is just making sure we get that. We had an example, the accrued, like an accrued expense. I'm talking about these accruals. I gave the example of the LED. We did have an example on the study guide for the test because I put this on there with payroll. So payroll, sometimes, the payroll period will fall in 2 different months and we want to close out May and maybe we haven't gotten paid yet for some of May. Well, then we need to figure out, well, how many days was it? And we prorate it. And we say, okay, here's what was for May that I need to pay to my employees, but I haven't given them any cash yet. So I know that I'm gonna be liable to pay cash in the future. So that's my salaries payable. My expense is what? It's gonna be a debit. And what account would I use for salaries?
The salary expense.
Correct. Right. So we would set up the salaries expense. Okay, then let's see. We had net sales. So when we talk about sales, we're selling product, and it's very common for somebody to return something, right? Sometimes you buy something, maybe it doesn't fit and you want to return it. Maybe the food's bad, you want to return it. So sometimes we have things that we sell and then something comes back. So we'll have our sales and then we may have these returns. Sometimes we'll give people discount. Maybe we want to try to collect our cash quickly. So what will we do? We would go ahead and say, okay, you know what? If you pay me my cash early, if you pay me within 10 days, I'll give you 2% off of that. So we have to know how to account for those things. But when we are looking at our net sales, the net sales means I want the sales less all those adjustments, less my returns, less my discounts, and then I come up with my net sales. Same thing can happen on the payable side. I know that you had some homework that you did this where maybe a vendor offered you a discount that if you paid within 15 days, you got 3%. So when you go to pay, you're getting 3% off of that. One spot that people get confused on is they forget if I return something or maybe a customer returns something, they forget to take that out. So if I'm paying $10,000 for equipment that I purchased and I didn't give anything back, well, I'm going to get my discount on the full 10,000, right? But if I go and I give you back, 1,000 of that, should I get a discount on 10,000? No, I have to deduct it. So I deduct my return and then I take my discount on the 9,000. So you want to make sure when you're calculating those that you're thinking about that. So the whole thing with the discount, it says it would, let me write it down on here. You still see my board? So when it's written this way, this means that if I pay within 15 days, I get that 3% discount. If I decide that I'm not going to pay it early, I need to hold on to my cash. I'm going to wait the 45 days. Well, then I have 45 days to pay the bill before it's late. And I don't get a discount. I pay the full 9,000. If I bought 10,000, I returned 1,000. My balance is 9,000. I chose not to pay it early. Then I have 45 days to pay it before I get hit with a late fee. That's what that means. Okay, so then the supplies, and I'm going to go over this just a little bit because the next chapter, chapter 5, I know that some of y'all have already done the homework. It's the inventory. So the beginning balance of your inventory, or your supplies, you want to make sure you know what that beginning balance is. So maybe I start the month with $5,000. When I purchase something during that period, let's say it's a month, I started with 5,000. I made a purchase of 2,000. Well, now I have to take my 5,000 that I already had available. I just bought $2,000 more worth of merchandise. So I have 7,000 available, right? Then I can look and see, okay, I can do an inventory and see what I have left. So what I have left will be my ending balance, right? The difference between what I had available and what's left is what I sold. See how that works? So you can back in depending on what number, as long as you know that format, whatever they give you, you can plug in and kind of back into another number. Maybe they want to know what's available and they give you the ending balance, they give you the beginning balance, they give you your purchases. And so you'll have to back into what was used. So the example I gave was you purchased $2,000 worth of supplies. You had 5,000 and my ending inventory is 2,200. So I know that I had 7, I'm left with 22. All I have to do is subtract to get what I used. So $4,800. Maybe they'll give you what you used and they want to know what's the ending balance. Well, then I need to know that I take what I had, I add what I purchased, deduct what I sold, and that's my ending balance. Does that make sense? Because you'll need to know that when you're doing your inventory. Okay, so that goes into chapter 5. So are y'all good with the exam? Any other questions? Let's see. And I'm going to leave that exam review up for you. That way you have it when you go into the final.